Afternoon. Why don't we go ahead and get started? Greetings. Thank you for coming on a Friday afternoon. My name is Tim Massid. I am a research fellow at the Mosavar Rahmani Center for Business and Government here at the Kennedy School. I'm also the director of a new project we have started called the Digital Assets Policy Project, which the goals of that project are to do two things. One is to organize events like this that provide opportunities to learn and discuss, uh, um, learn more and discuss the public policy issues pertaining to digital assets broadly defined, whether that's crypto tokens, stable coins, CBDCs, or other things. And the second goal is to get the Kennedy School more involved in the policy discussions. So, for example, we had a workshop last month, a two-part workshop, which I think a few of you attended because I see some familiar faces, where you could come and learn how to uh, create a digital wallet, create your own decentralized autonomous organization, and then trade tokens. Uh, on the other hand, we had a roundtable that Professor Hal Jackson, who's here, and I hosted late last year on stablecoin regulation, which was a by invitation event, but we had about 25 top officials from the government as well as stablecoin issuers and other financial institutions discuss some of the issues involved in stablecoin regulation. We have former SEC Chairman Jay Clayton coming up in on April 11th. He'll give a talk on crypto regulation. He was instrumental, really was the leader in the effort to uh, regulate internet coin offerings, ICOs. Some of you may remember the ICO mania that took place in around 2017 until the SEC came along and said, you know, these are really securities offerings. You have to comply with the rules. Um, and we'll have some other events too. You can just go to our website and see that. I am just delighted that today we have Bo Lee with us. Bo is the deputy managing director of the IMF, the International Monetary Fund. He has been there since August of 2021. And he is responsible for the IMF's work in around 90 countries on a wide range of policy issues. Before joining the IMF, Mr. Lee worked for many years at the People's Bank of China, and among his positions was deputy governor. So he was very involved in the reform of state-owned banks, the internationalization of the renminbi, and the establishment of China's macro-prudential policy framework. Before that, he was the vice mayor of Chongqing, China's largest municipality with a population of over 30 million. So he's had quite a range of responsibilities. And on top of all that, he started his career at the New York law firm of Davis Polk and Wardwell, where he was an attorney for 5 years. He has a PhD from Stanford University, an MA from Boston University, as well, and both of those are in economics, as well as a JD from Harvard Law School on top, and that's in addition to his undergraduate education at Renmin University in Beijing. So quite a distinguished academic career. So without further ado, I want to welcome Mr. Bo Lee. Thank you.
Thank you, Tim. Very, very pleased to be here today, especially with some of my former professors, Professor Jackson here, some of my former colleagues from Central Banking Circle, Mr. Tucker. Very nice to see you here. We have been haven't seen you for many years, so very, very nice. It's also nice to be back to Harvard. I just had a lunch talk at law school where I spent 3 years, more than 24 years ago. So today my topic is crypto regulation. My purpose today is to give a factual view of the global landscape. and also ask some questions that I think need to be answered if we want to be better equipped to when we design crypto regulation. Um, so, what is crypto? Three key features: cryptography, tokenization, and common ledger. And for the ledger part, there is a disagreement. Some people say it has to be distributed ledger, but some other people say it doesn't have to be distributed. So that's why I use common ledger. And typical crypto assets, unbacked Bitcoin, backed stablecoin, etc. There are also other tokens like utility tokens and security tokens. And currently, there are different countries have different approaches towards crypto. At one extreme, there is a adoption of crypto as legal tender in El Salvador, Central African Republic. Another extreme is banning of crypto, such as China, Egypt, Nigeria. Most countries are in the middle. They try to get their hands around crypto and find some kind of regulatory solution. There are international efforts to provide clear and prudent guidance for financial institutions in terms of dealing with crypto. The latest one is the Basel Committee on Banking Supervision, BCBS, guideline for banks. Some countries are also trying to put together guidelines, regulations, rules. The European Union just issued some guideline on regulation of issuers and service providers of crypto. For the U.S., we also see enforcement activities by SEC and CFTC. We also see a presidential task force coming out with a report on what they think is the best stablecoin regulatory system. And there is also proposed legislation in Congress. And there are also targeted ban of certain part of the crypto space, like in UK, banning of crypto derivatives. So as you can see, this is a wide spectrum of responses, regulatory responses. And this is a picture that we use for the IMF board meeting, which happened a couple of weeks ago, which I chaired when we tried to introduce a new paper on crypto, which was issued yesterday, if you look to the website of the IMF. So you can see that we have a spectrum of regulatory responses from do nothing to full ban. There are factors in deciding a particular country, influencing particular country in terms of what kind of regulatory response a particular country adopts, including the resource constraint, capacity, the challenge of enforcing rules, and also the lack of clarity in terms of what are the international standards in this space. That's why there are very widely different regulatory responses. So I'll quickly go through a couple of countries for you. One is China. As China still have exchange controls, so international cross-border investment on crypto are limited, but there are people are doing it in different ways. In 2021, all crypto asset activities were banned and declared illegal. Before that, China was the largest source of crypto mining, and China is also a big source of crypto money in terms of the international market. There are speculators from China. There are also people trying to circumvent capital flow management. Since the ban in 2021, as you could naturally imagine, some crypto mining firms have moved. At least on the surface, we don't see mining activities now in China. Some Chinese residents still active in trading crypto assets. They do it, as I said. There are underground banks. There are other ways that they can move money out. There are also differing assessments in terms of the extent of remaining crypto activities in China. There is one market firm, I think it's one of the analytical firm, still rate China as high in terms of crypto adoption. So China is still regarded as high by this particular firm. For Chinese regulators, they think that for the most part, activities within China are gone. Of course, there are still, as I said, people move their money out to try to be investors. And that has been the case for the last, 30 or 40 years for other assets as well, like real estate, right? So this kind of underground banks moving money out has been there. It's not something new. The other extreme is El Salvador. In 2021, the same year as China banning, Bitcoin was adopted as official currency, as legal tender in El Salvador. Although the use is still very limited by, so far less than 2% of remittances, and 97% of business have not made any sales in crypto, and 66% of the population consider Bitcoin a failed project. But the authorities' support remains strong. There is a digital asset law. There are authorities exploring the issuance of tokenized bonds to fund new Bitcoin investments. Our advice to the country is that they should abandon that practice. We regard this as very risky, both for monetary, for fiscal, and for financial stability and balance of payment. And the last country I want to go is the U.S. U.S. is in the middle camp, trying to regulate the both mining, trading, and DeFi transactions among the highest in the world. Retail investors dominate the market, but there is also significant institutional investment in the last couple of years, at least before the crash. The launch of Bitcoin futures, the introduction of Bitcoin ETFs, and also the availability of financial infrastructure have all supported the growth of the market globally because of this U.S. presence. And in addition to the U.S., there are also a number of countries that we invited to a focus group discussion last month in India, because this year is Indian presidency of G20, and the host takes a strong interest in crypto regulation. So we hold this roundtable discussion with 8 countries, mostly from Asia, South Asia and Southeast Asia, and also East Asia, with one exception, which is South Africa. And there are some themes emerge from this discussion I want to go through quickly. One theme is that in terms of adoption and usage, adoption levels are not systemic, but become substantive for many countries. And speculation for unbacked, while stablecoin are driven by transaction. Traditional financial institutions are not very exposed yet, but they are interested in the technology. Policy approaches differ. Some countries focus on protecting investor and consumer, while others focus on financial stability and financial integrity. There is a consensus that we should leverage the technology to offer more stable and productive services, including by the public sector CBDC, including private sector possibilities. There is a strong interest uniformly that in addition to CBDC, regulators and central bankers and finance officials are hoping that some private crypto assets, if they are well regulated, they hope that they can also play a productive role. In terms of domestic implication, financial stability risk were not seen as critical, not yet. Um, and fiscal implications subdued, at least for now. And countries are successfully taxing crypto assets right now. Of course, there is concern about bank disintermediation and currency substitution for many of these countries, especially if you are a small country, and there may be a strong interest in foreign currency denominated stablecoins. Financial inclusion is widely seen as a potential benefit. However, digitization is only one part of it. To realize that gain, financial inclusion, there are more things that need to happen, including financial literacy. And financial integrity is a concern, but to resolve that, we need data, which remains challenging. Concerns about the environmental impact are now largely subdued because the new technology, the new generation of technology, which is a proof of stake instead of the old one, which is a proof of work, seem to be much more energy efficient. And all participants expressed concern about capacity. There is not enough capacity, both in terms of human capacity and technology capacity. The last part is on international implication. And there is concern about monetary policy transmission if there is significant currency substitution. And capital flow is another concern, as is naturally, worried by central banks and regulators. Implementing capital flow management (CFM) can be more difficult, and of course, the precise extent of that challenge has to depend on data, and we don't have data. Again, most participants think that CBDC and well-regulated stablecoin could improve cross-border payments. But again, it relies on whether we can properly regulate it and whether proper infrastructure can be in place. And also there is an expectation that multilateral organizations like IMF should play a role in terms of cross-border payment. So that is the result from that focus group discussion from those 8 countries. There's also some work on the drivers of crypto adoption, and regression analysis shows that macroeconomic conditions, currency depreciation, exchange rate volatility, and inflation are important drivers. That is suggesting that at least for many investors, currency, let me say, hedging is an important driver for adoption of crypto. Currency depreciation, in particular, is a very significant variable in explaining the adoption of crypto. And demographics turns out also to be a significant factor. In fact, the older your population, the less crypto adoption. And of course, regulatory capacity and financial literacy are also important considerations, especially for countries like China. One of the main reasons for China to ban crypto is precisely because of concerns about the regulatory capacity and the financial literacy of the population. So that finished my first part. It's like a global review, a quick review of a global regulatory landscape. The next question I want to quickly discuss is why. Why should we bother? Why do we need to be concerned about crypto? Why should we just let them burn in the wilderness, right? Why should we grant them a level of legitimacy by regulating it, right? Because we see influential authors like Professor Krugman saying that, let's ignore them because this technology is garbage and they're not doing anything good, and let them burn. Um, and of course, we are in a different camp. We means IMF and many central banks, regulators around the world. We think that there are both direct cost of inaction and opportunity cost of inaction. And the direct cost we can see in this failure of this latest FTX exchange, and there are potentially millions of uninformed investors that could be hurt in the in this market. The opportunity cost of inaction, of course, people talk about the potential benefit of this technology, cryptography, tokenization, and distributed ledger could potentially increase, financial inclusion, could potentially improve the efficiency of financial market, and also potentially improve the security of financial transactions. And people give examples. Some stablecoins start to find acceptance outside of the crypto space, and they could potentially provide cheaper, faster, and safer payment instruments. And also, traditional financial institutions like, stock exchanges and financial intermediaries, they also find it beneficial to adopt, distributed ledger technology, cryptography, to improve the efficiency of settlement, clearance, bookkeeping, etc. So there are some tangible benefits we are already starting to see in the crypto space. And also there is an argument saying that if so, why should we just allow traditional finance to utilize, the technology? Why should we allow new player into the house? Why should we just focus on traditional players and let the traditional players adopting the technology? I mean, there are many arguments saying that, we should not only allow traditional animals, we should allow new animals, because traditional animals, they are geared differently. They are genetically different from the new players. And we need new players because we need genetically different players that could create new business model, could bring new use cases. People give examples of Alibaba in China, right? Alibaba is a big player in the financial space now, even though the last couple of years is difficult. But for the most part, people regard it as a new player in the house, a genetically different player, but they are bringing new use cases. They are bringing new business models. They are lending on big data. They are not lending based on traditional due diligence. And they quickly expand their balance sheet. Of course, their balance sheet is not big enough. So they also sell a lot of their loans originated by themselves, by Ant Group to other banks. They become the biggest micro loan underwriter in China. So all this could not have been possible if we say, oh, we don't want new players. We want traditional players like banks. They can utilize new technology and they can become a very good boy in the house. And they are good. They will be good, but they won't be as innovative. And they will be good. I mean, banks will be good, but they won't have the gene to produce, new use cases, and they don't have the use case. They don't have the context. They don't have the e-commerce platform. They don't have the. I'm talking about the traditional players. They don't have the e-commerce platform. They don't have the social network platform, and for them it's very hard to produce the synergy between e-commerce and finance. The synergy between social networking platform and finance. On the other hand, new players like Alibaba and Tencent, for them, they are born, digital, and they are born with a large platform of millions and billions of investors and customers. So for them, it's very easy to produce a synergy, to produce new business models. So the argument, I think, is very strong to allow new player into the house. If we want to to see new business models and new synergies. Of course, there is also the wishful thinking that we can just let them burn. in the wilderness. I think the failure of this FTX shows that they won't burn in the wilderness. They're going to burn the house, at least partially the house, right? So, so I think there are arguments that we should care, we should be concerned, and we should think about regulatory solutions. And my final question is how? How to think about financial regulation, how to apply our existing regulation to crypto. Do we need new regulation? Is crypto very different from existing financial assets? If there are new animals, do we need a new paradigm, right? Talk about financial stability, investor protection, and financial integrity. But also talking about a level playing field and financial dynamism, right? We don't want to stifle innovation. We want to use the proportionality principle in thinking about financial regulation of crypto. So all these factors are relevant when we think about regulating crypto. So I use this metaphor when I chaired the board meeting last time. I say, how to think about crypto, right? So crypto right now is in the wilderness. And he wants to enter the house of finance, right? We need to decide, first of all, whether we should allow crypto to get into the house. What kind of hurdle they have to climb, they have to jump over if they want to get into the house, right? And the second question, if you want to get in the house, which room we put crypto, right? We put this animal. Is it a monetary and banking room, or it should be a capital market room, or it should be commodity and futures room, or some other room, right? So these are the questions we need to think about. Or some people say, oh, they are fundamentally different. They do not fit into the existing room. We need to build a new room for crypto. Some people say we should build a new house for crypto because it's a completely different kind of game, right? So my sense is that at least for the most part, most countries today are talking about making crypto part of the house, part of the existing house, part of the existing regulatory architecture. Of course, we may need some, new rules or new infrastructure, new regulatory arrangement. But fundamentally, the existing house is okay, and crypto want to enter it, because if they don't enter the house, they will not be allowed to access the millions and billions of customers and investors inside the house. So they can only stay in the wilderness. So in terms of regulatory challenges, the decentralization aspect of crypto is challenging. The anonymity, the permissionless blockchain, and the ease with which it can cross border. These are all challenging aspects of crypto regulation. Even if we apply the traditional architecture, I mean the traditional regulatory framework, we'll find that technologically and capacity-wise, it may be hard to pin down some of the elements of regulation. For example, who's the issuer of the crypto? Without the issuer, securities regulation may not be able to do it effectively, because securities regulation focus on issuer and the underwriter, and you cannot find either sometimes for crypto, right? So securities regulation can be very difficult if you don't have an issuer or underwriter, right? So anonymity, right? And anti-money laundering. If this blockchain, this Bitcoin allow anonymity, then anti-money laundering regulation can be difficult to apply. So even if we want to get this into the house, even if we say, oh, this is a security or this is a commodity, it may be still difficult to pin down which person, which entity you should focus on, or which activity you can focus on, or which stage of the development you should focus on in terms of regulation. And of course, the international bodies are trying to get a handle on this. CPMI, the Payment and Market Infrastructure Committee in Basel, FSB, the Financial Stability Board, have all come up with recommendations in terms of how to think about crypto regulation. And BCBS, as I said, last year put out the prudential treatment of crypto asset exposure for banks. So that part is for banking exposure to crypto. And for IMF, we have done analytical work. And we have, it's no longer upcoming. It's the latest paper we released yesterday, the board paper on crypto. And we have published a number of staff discussion notes, blogs on crypto. And the latest paper we released yesterday, we focus on 9 elements we think are important for effective policy, for effective crypto policy. The 9 elements are divided into 3 aspects: macro financial aspects, legal and regulatory and supervisory aspects, and the international aspects. This is the table we use for the board meeting. So for the macro financial aspect, we need to consider monitoring sovereignty and stability, and do not offer crypto asset official currency status. Element 2 on capital flow, guard against excessive volatility. Element 3, need to start to analyze fiscal risks and tax treatment. That's the macro financial aspect. Macro financial, I would say macro fiscal, macro financial aspect. The first 3. The next 3 is on legal, regulatory, and supervisory. Element 4, legal certainty is important. Element 5, prudential conduct and oversight requirements. That's the kind of the things I talk about in that house, right? Are you talking about securities regulation? Are you talking about commodity or future regulation? Or are you talking about monetary or payment regulation? Element 6, monitoring across different agencies as authorities. That's in order to have data. So that's the second aspect. The last aspect is on the international aspect. We need enhanced international collaboration on supervision and enforcement. We need to understand the potential impact of crypto assets on the international monetary system. We also need to think about develop digital infrastructure and alternative solutions for cross-border payments. And there are ongoing work streams under G20 and under FSB on cross-border payments. And IMF is also participating. So we have come up with very high level 9 recommendations or 9 principles. So what's next? I mean, there are a lot of the hard work is still ahead of us because it's easy to come up with high level principles. The challenge is on the nitty gritty of thinking about and designing specific regulatory rules and regulatory regimes and dealing with those challenging aspects of faceless and permissionless and centerless and borderless cryptos. So what I would suggest, I would spend the remaining time on 3 key questions, especially the first one. Because the way going forward, we need to think about when we design the regulatory rules, we need to think about the taxonomy. We need to think about how to classify crypto assets. Crypto assets can be payment instrument, can be investment asset, can be hedging instrument, and can be many other, right? But for financial regulatory purposes, I think these 3 are the key to understand crypto. Is it a crypto? Is it a payment instrument? Or is it an investment asset? Or is it a hedging instrument? Or it's all. They may be all, right? Maybe some crypto promoter want to be all. We want to be a payment instrument. We also want to be an investment assets. So for each of this category, there is a key question. Is it money if it's a payment instrument? Is it security if it's an investment asset? Also, a related question is it a collective investment scheme, right? And third, as a hedging instrument, is it a commodity or is it otherwise covered by futures or derivatives law? I will focus my discussion today on the first question because I understand from Tim that Kennedy School, and this center has organized a number of roundtables and discussion on the second and third question: is it security? Is it commodity? And so my focus will be on the first one: is it money? Taxonomy, existing literature, and policy options. So what is money? If you look at a typical textbook, it will be saying anything serves as a medium of exchange, unit of account, and store of value. Of course, in the modern monetary system, money is either central bank liability or commercial bank liability. Basically, you're depositing in the bank, their money, right? Your cash, that's central bank liability. And what is currency? Currency is basically what we call official money. That means mostly cash, coins, banknotes, currency. Currency is typically associated with official money, right? Central bank money. And money is broader than currency, of course. As I said, money includes commercial bank liability. Anything issued, there can be private issuer of money, private issuer like commercial banks, they are private, but their deposits are insured by deposit insurance scheme. So their liability are somehow supported by deposit insurance, and that scheme are typically established by the government. So commercial bank liability can be money mainly due to it is insured by a scheme established by the government in the modern economy. Payment instruments are used to effect or facilitate transfer of money, right? So some people say, oh, crypto, I'm not money, but I want to become a payment instrument. So my question is, if you are a payment instrument, you are fulfill at least one function of money, right? Which is medium of exchange, at least one. So if that's the case, we can argue how much of a money we should regard crypto that aspire to become payment instrument, right? So that's a question we need to think about. Are there payment instrument that is not money? Of course, I mean, if this payment instrument is limited to very limited circumstances, like utility token, right? Or like in a particular community or in a particular society or a particular internet game, right? There are tokens that are used as payment instrument, but they are not widely accepted payment instrument. So what I argue is that money must be widely accepted payment instrument. That means not only it is accepted within the crypto space, it may be accepted outside of the crypto space as a general means of payment. If you want to be used outside of the crypto space, or it is as a factual matter already used outside the crypto space, I would say, okay, you are getting more and more like money because you are used outside of the crypto space, right? So again, it's a matter of degree. There is no black and white whether it's money. You can say, oh, it's already money in the crypto space. I agree. Many of the utility tokens, you can regard them as money in the crypto space. But that's not for financial regulation purposes. For financial regulation purposes, we are talking about money that are widely accepted payment instrument that is used outside, that can be used outside of the crypto space. So the question is stablecoin money? Is stablecoin currency, right? So let's look at some existing literatures. So Holmstrom's paper in 2015 says that debt is money only if agents accept it, NQA. No question asked, NQA. What does no question asked mean? That means agents accept it without hesitation. And there is no need to do any costly due diligence before you accept it. That's NQA, right? And there is also literature on private money, how to create private money, right? Private entity, how can they create money? I told you that for the most part of last, at least last century, right? Only a commercial bank as a private entity is allowed to create money, right? They were allowed to create money partly because they have the deposit insurance and they have a level of support from government. So optimal design of private money is debt backed by debt, right? If you think about commercial bank liability as per commercial bank debt, it's backed by deposit insurance, right? So that's another debt. And this is private money. And this paper by Gordon Ross and Ross 2022 says, found no example of widely circulating private money that is NQA without government backing, either implicit or explicit. I mean, that's understandable, right? Because as I said, in the modern world, only commercial bank money is the only private money we see. I mean, in a scale in any country, right? And this commercial bank money is backed by deposit insurance. Historically, money that is NQA is a public good that only the government can supply. And in this paper, the author speculates stablecoin may need some kind of government guarantee to become NQA. So the question is, what kind of government backing is needed for crypto to become NQA? Because I'm here using the interchangeably NQA, money, WAPI. WAPI means widely accepted payment instrument. So there are three options, right? Stablecoin, they can be backed by highly rated and liquid money market instruments. This is the EU regulation. The recently issued EU regulation requires stablecoin must be backed by highly rated and liquid money market instruments. The second option is insured commercial bank deposits. And this is a paper by Liao and Karamiko. They are advocating for stablecoin if they want to become a payment instrument, a widely accepted payment instrument. They need to be backed by insured commercial bank deposits. And option three, central bank reserve. That means the issuer of stablecoin have to put every dollar it collects in with the central bank. So remember the question I posed is, if we want this stablecoin or this crypto to become NQA, right? So I'm not saying the EU regulation have that goal, because the EU regulation does not say what kind of role they have in mind for stablecoin, right? If you say stablecoin is just an investment asset, that's a different question, right? Because you don't have to make it stablecoin WAPI. You don't have to make stablecoin NQA, right? But my question is different. My question is, your intention is one thing. The reality is another thing. Because in reality, if people think stablecoin is stable and it's easily to transfer, they may be accepted by individuals as payment instrument, even though the regulation may not intended it become a widely accepted payment instrument. So your intention may not be to make stablecoin money, but the reality, it may become a money to some degree. It may be accepted by some people as payment instrument. So if that's the case, for me, if you want to call something stablecoin, there is a likelihood that this stablecoin can be accepted as payment instrument, especially if there is a regulation behind it, right? If the EU regulation come into force, saying all stablecoin has to be backed by highly rated, highly liquid, instruments, people will say, oh, this is good. This is backed, and this is regulated. I will accept it. If you pay me, $1 million of stablecoin, I may accept it. So if you have regulation, and if you allow this crypto to be called stablecoin, then there is a likelihood, I think, that this stablecoin may become payment instrument. And if so, we need to ask, we need to ask, is the regulatory arrangement proper for the for this guy, for this animal to become payment instrument? And in order to become WAPI, I would argue this payment instrument has to be NQA. Otherwise, we're going to see crisis down the road, because one day this stablecoin may not be stable, because your regulatory arrangement may not be sufficient to make it NQA, right? So that's why I'm asking this question. In order to be NQA, which option would you prefer for this? If I offer you a stable coin, you say, okay, I'm going to pay you $1 million of stable coin, and you ask, what kind of backup this stable coin has? I will say, oh, I'm following EU regulation. It's backed by AAA, government papers. And would you feel comfortable to accept that stable coin? Or you say, oh, that's not enough. I'm not going to accept it because it may not be NQA, right? Because we know after the money market mutual fund fiasco in GFC, in the global financial crisis in 2008, money market instrument may not be NQA because they may not be stable. That's why the USA has changed its regulatory rule. It no longer require or allow money market mutual fund to keep a stable value at $1 per share. Prior to 2008, all the money market mutual funds, they have a stable value, $1 per share. It's like the predecessor of stable coin, although at that time it's not tokenized. But it's very similar, right? It's NAV, net asset value, $1. So it's very stable. However, in the financial crisis, they're no longer stable. They're no longer stable. The US regulators, they have to step in. The Fed has to step in. So after the financial crisis, the SEC changed the rule, say, money market fund, you cannot peg your share to $1 because that's misleading. Because your asset side may suffer loss in financial crisis. The backup is not NQA. It's no longer NQA. Insure commercial bank deposit, the second option. I also have some doubts on the second option because deposit insurance all have a cap, right? In the US, it's $25,000. Oh, $250,000, sorry. In the US, it's $250,000. Right? In China, it's 500,000 coin. There is a cap. So for a stablecoin issuer saying, oh, I'm going to put every dollar I collect into the bank, and this bank, they have FDIC insurance. Then people say, oh, it's only insure up to $250,000. So you can only issue stablecoin up to $250,000. Is that good? Oh, it's good because it's safe, right? You can only issue up to what is insured, right? It's good, it's very safe. However, it's very small. If you only allow stablecoin issuer to only issue $250,000, players like Alibaba or Tencent, they won't be interested because that's such a small game to play. For Alipay, it's trillions of yuan. They cannot be insured by any bank. I mean, the banks will not say, okay, you deposit your Alipay balance all with me, with ICBC. And Alipay will say, oh, I deposit with you. I only have 500,000 insured by the Chinese deposit insurance agency. The rest, trillions of coin is not insured. Then it's no longer NQA, right? So deposit insurance has a very small cap for big players. And you want big players to be on the market because you want to realize the benefit. I mean, the benefit of crypto. You want to realize the scale. You want to realize financial inclusion. You want big players to be on the market. Small players will not give you the benefit of crypto, right? If you want to realize the benefit of crypto, you want big players. If you want big players, deposit insurance is not enough. At least as currently structured, cannot support NQA, cannot support NQA. So that leaves option three. That leaves option three. To me, option three is right now as a policy matter, seems to be the only possible way for NQA. And that is what China is doing. China requires Alipay, Tencent Pay, WeChat Pay, to deposit every coin they collect from their customer with PBOC. And this Alipay and Tencent Pay, they're not even tokenized. They're not even crypto. They are e-money. So even for e-money, China has a very tough regulation. People don't understand why. Why China is so tough ask e-money to be backed by 100% central bank reserve. And I can tell you why. And we did this after many years of struggle and discussion and debate. Because if we don't do that, if we didn't do it, we face bigger challenges. One challenge is obvious. You are facing a big player like Alipay with trillions of liquidity. If you don't require them to deposit with central bank, Alipay can become the biggest provider of interbank liquidity after central bank. It became a shadow central bank. Do you want that? I mean, for most central bankers will say, no, we don't want a shadow central bank out there, right? Has such big pool of liquidity that can influence interbank interest rate. You don't want that. You don't want that. That's why, that is at least one reason you want to lock in that liquidity with central bank, because you don't want that player to interfere with your monetary policy operation. So we did it not because we wanted it to be NQA. We're thinking about monetary policy transmission. But now if you are talking about a private issue token to be widely accepted payment instrument, there's an additional reason why you want central bank reserve backing, because as I said, you need to make it NQA. And to me, the most sensible way to make it NQA is central bank reserve. But again, that's subject to debate. I'm saying my personal view. I don't think there is any consensus yet, and we can debate today to discuss today what are the options you think are most sensible for stablecoin to be properly regulated. I think I stop here and we can discuss.
Oh, that was terrific. Thank you so much. Let's open the floor to questions. I'm going to start us off with a question in terms of what does it take for a stablecoin to be accepted as NQA, but rather from the philosophical point of view, let me just ask you what you think would have happened if El Salvador had said, instead of Bitcoin being legal tender, that Tether was legal tender. Your statistics said 67% of the people didn't accept it, 97% of businesses didn't accept it. Would that have worked?
I can only guess because we don't know, right?
Right.
It's counterfactual. It may do a little better because Tether is more stable than Bitcoin. If I'm a shop owner, I wouldn't accept Bitcoin because it fluctuates so much.
Right.
So Bitcoin is not well suited as a payment instrument precisely because it fluctuates so much. But I guess my counter question is, the government has the option to choose. So why did it choose Bitcoin, not Tether?
I don't know. If
I don't know
if I
either.
were advising them, I would have said choose Tether if you're going to do anything. But
I don't know
anyway,
either.
let's get some questions. Yes, Alvin.
Thank you for the presentation. My question is whether it will be feasible or not for regulators to catch up with all of the innovation happening in the crypto space. So I attended a workshop organized by Tim a few weeks ago, and it was basically very easy to mint your own coin. You can create your own DAO, and Imagine if Tim's workshop was replicated everywhere around the world. People could mint their coins easily. It means it'll be tough for regulators to catch up with all of these new coins and all of these exchanges and to identify who is like the ultimate shareholder of the DAO. So, do you think it would be just better if regulators think crypto as something that is very much segregated from the traditional financial system and put a ban on all the traditional financial institutions from doing any business or activities with crypto, such as what the BCBS has done with the banking sector? Thank you.
Um, First of all, you know, we do this with a level of humility in the sense that market is always before regulation, right? Because regulation we try to catch up because market they have so much innovation, they have so much energy, and rightly so because we only have so few regulators, and regulators are facing with millions and millions of investors and firms, right? So it's natural that regulations are behind. Regulations try to catch up, and secondly, as I already described my take on this, which is that it's true. Many of the technologies we may not understand yet, or we may not know how to regulate it yet. But do we still need to bother to regulate? I think we need to bother because the crypto players or issuers or promoters, they want to access our house because our house has millions and billions of investors and customers. And so the way for us is we are the gatekeeper in a way, right? Regulator is the gatekeeper. You want to figure out whether we should allow this animal into the house, because if they get into the house, they're going to access all the customers and investors. And that's also an incentive for the animal to talk to us, right? Because if they don't talk to us, we're not going to allow them into the house. That means they can only stay in the wilderness, or they can have small scale experiment. They can have small scale, even small scale market. That's fine, with sophisticated investors. However, if you want to access unsophisticated investor or customer, that's where I come in. I will say no, unless you talk to me, and unless I figure out which room I put you in, and which rules I should subject you to. Because if I don't figure that out, I won't allow you to access those unsophisticated people. Of course, you will say, oh, they will still do it anyway. That's true. They will still find ways to get to those unsophisticated, moms and pops, but they won't do it in a systematic and in large scale because precisely regulators in most countries, at least in the more developed countries, they have the capacity at least to go after you if you go if you reach unsophisticated moms and pops. There are ways to go after. Both the regulators and prosecutors can go after, and of course, we want to do that in a way that can create the least damage to the population, the least damage to financial stability. And as you said, we can do two things. We can limit the exposure of financial, the mainstream financial sector to crypto. If this crypto is not properly regulated, right? We can limit the exposure of the traditional animal. And then we can try to protect the moms and pops, the unsophisticated investors and consumers. So these are the two main we are the gatekeeper. We regard ourselves. I think regulators should regard themselves as gatekeeper. And of course, different countries regulate do it with a different degree of success. But largely, at least in the large market, I would say regulators have relatively effective tools to be a good gatekeeper in for both gates. That's how I view it.
Thank you very much. Good to see you back here.
Thanks.
The interesting thing about option 3, the central bank reserve, is how close it is to a central bank digital currency. So you've solved the asset stability problem. There's still a lot of stuff you have to solve, the money laundering. There's many other pieces. And I just wonder, how do you think about all the other work that needs to be done once you brought it into the central bank, as opposed to just having the central bank do the whole thing? It's hard. It's sort of a little hard for me to envision an e-money solution like this next to a central bank digital currency without one of them taking over pretty quickly.
Very, very good question. I actually have several more slides precisely on your question. So if a country chooses option 3, in effect, this stablecoin can be regarded as a synthetic CBDC. My colleagues from IMF, Tobias Adrian and Tommaso, they wrote an article. They wrote an article 2 or 3 years ago on synthetic CBDC. Synthetic CBDC means private issuer, but backed by central bank money, by central bank reserve. So if a country chooses to make stablecoin NQA by utilizing option 3, basically they are saying, we allow stablecoin only if it's a synthetic CBDC. That's my first point. My second point is that you are very right. This is very much like CBDC. CBDC is a direct central bank liability, right? Central bank. This stablecoin is an indirect, liability because it's backed by central bank liability, right? So do you want a CBDC that's direct central bank liability, or you want a private issue token that is backed by central bank liability? I guess that's the question, right? So these two are very similar. They are either direct liability of central bank or indirect liability of central bank. So why do we still need we still need to discuss this option? To me, it goes back to my earlier point, which is for CBDC to succeed, central bank cannot do it alone. That's what we learned in many countries, including China. Central bank cannot do it alone for CBDC to succeed. In China, we had a 2-tier system, right? Central bank is the issuer, but who's the distributor? Commercial banks, technology companies, telephone companies. So in China, we are forming a network of distributors, not only commercial banks. We are also talking to Alibaba, Tencent to ask them to be distributor, and also China Telecom, China Mobile, telephone companies. So we realize that central bank cannot reach millions and billions of customers, and central bank doesn't have any use case, right? Only the distributor, the second tier, the distributor, the commercial banks, the technology companies, the e-commerce companies, they have use case. They have the context. They have the network to reach millions or billions of customers. They can create a synergy between money and trade, money and e-commerce, money and social network, etc. So we realize that for CBDC to succeed, it has to be PPP, has to be public-private partnership. So if that's the case, if CBDC has to be a PPP, has to be public-private partnership to succeed, this synthetic CBDC, this stablecoin option 3, is also a PPP, right? This synthetic CBDC, this option 3, is also public-private partnership. It's a little different from a direct liability of central bank, but still it's a PPP, right? It's a public-private partnership. It's backed by central bank liability. And we may want to do this because those issuers, those technology companies like Alibaba, they have the network, they have the use case, they have the, financial incentive to do it. So I guess my answer is that if a country wants to have CBDC, if they have to do it through PPP. Maybe both kinds of PPP can be tried, can be experimented. Of course, in reality, we haven't seen any country try that yet. I mean, the only thing getting close to this is Hong Kong. Hong Kong, they have privately issued banknotes, right? The HSBC, Bank of China, Hong Kong, they are issuing cash in China, in Hong Kong. They are issuing physical cash in Hong Kong, backed by central bank reserve, right? So Hong Kong has a system, not digital yet. It's physical cash, but they can easily make that digital. They can allow, HSBC, Bank of China, Hong Kong to issue digital cash, which is stablecoin, digital cash, backed by central bank reserve, right? Because right now their physical cash is already backed by central bank reserve, right? So for Hong Kong, it's a natural step to go to digital, go to option 3, right? The question is whether other countries want to try it. My argument is that if you want to make any private stablecoin to be NQA, I think option 3 probably is the only feasible or only sensible way to go. Otherwise, you say we don't do it. That's fine. If you don't want to try, you say we focus on real CBDC. That's fine. But some other country we want to try both. Why not? If they want to try both, I would argue option 3 probably is the only sensible way to go for private stablecoin to become to be widely accepted as a payment instrument.
It's very good to see you again
Thank you.
after a long time. So as you were speaking, I thought there was a tension in what you were saying, and then I changed my mind about where the tension was, given where you ended up, because you ended up advocating for a central bank digital currency. So a lot turns on whether there's complete backing with central bank money or not. Say there is not complete backing, which is the case with commercial bank money. I hold all my money in commercial banks. Then the question is about moral hazard. And my former world, your current world, failed to address that because it didn't address, so what happens when the bank fails? Of course, I claim that the committee I chaired has now solved that problem, but history will reveal that to us. So anyway, in this world, if there's not full backing, then you need a resolution policy for digital currencies. And I'm not criticizing, but whether listening to you today or John Cunliffe in London, no one kind of nails that, which is the mistake that the generation before me and you made. That's option A, where there's a big policy issue. Option B, there's a different kind of policy issue, less so for your country of origin than for, quotes, Western countries, which is if there is full backing, then there's a question about why doesn't everything move out of commercial bank deposits with a limited deposit insurance into the fully backed digital currency. And some members of our community, my former community, including one of the people that got part of my job, say, well, actually, we'd put a limit on it, put a high limit on it. That will work until under stress. When it comes under stress, people will say, oh, when we said you could actually only have 500,000, of course, now the world is falling apart. We really mean you could have as much as you like, because that's what people do. So here's the big issue under the second option. In the second option, everyone eventually, who knows how soon, ends up banking effectively with the central bank. Everything moves out of commercial banks. That means that credit allocation is now within the hands of the central bank, which also actually knows everything about everybody. If I was working for the party in Beijing, I think that's fine, given my understanding, which isn't as firsthand as yours, but is not completely superficial, of the regime. If I was sitting in Washington or London or Berlin or Paris or Tokyo or Seoul, I'd think, hold on, I don't want to have credit allocation in the hands of the state, or actually, more carefully expressed, I don't want to end up in that situation by accident because we have a financial crisis. Maybe we should change our system, but I'd like a debate about that rather than my central bank governor coming to me and saying, well, I am now the whole banking system. So it seems to me that your articulation of this and all my other friends kind of leaves to the side really massive issues. One is, if it's not fully backed, what's the resolution mechanism? If it is fully backed, how do you avoid the central bank becoming the state credit bank? And I addressed the second in my book, Global Discord, but not the first.
Thank you, Paul. As always, you are as sharp as ever. I always enjoy Paul's intervention in Basel years back. Yeah, I agree with you. I think we're leaving out some important questions. And what I would add to what you have already said is that I think crypto is different in a way that crypto is not traditional money. If crypto become money, it's very close to high power money. That's why option 3, right? Because it's digital and it's cash. So it's cash. I mean, cash already is very different from other money, right? Cash is already very different. That's why in Hong Kong, these 3 banks, if they want to issue cash, they have to 100% backed, right? If you just issue deposit, you can be partially backed, as Paul said, right? For deposit, it's partially backed by the government. It doesn't have to be fully backed. I agree with you. But for cash, it's very different. Cash is traditionally, central bank or government's, prerogative. I mean, not traditionally, but at least in modern economy, right? And when you have cash combined with digital, I think it will be very different from traditional commercial bank money, and that's a traditional private money. I mean, when I talk traditional, I'm thinking about in the modern age, right? So in the current system, we have a lot of private money. I mean, they are issued by commercial banks. They are commercial bank deposit, but crypto is very different from commercial bank deposit in both aspects. It's cash. Cash means delivery is settlement, and second, it's digital cash. That's even more powerful than traditional cash. Right. Very good point. We debated that actually, even at IMF. So what about tokenized deposit? And some people, including myself, have some conceptual difficulty with tokenized deposit because you are combining 2 very different animals, right? Token money is very different from account-based money, right? Account-based money, like your deposit in the bank, is account-based. You need to open an account. The bank, you need to check your name, your identity, your background, whatever, right? There is due diligence, there is know your customer, there is anti-money laundering. So commercial bank account-based money can be partially backed because they have a lot of other safeguards. Account-based money cannot be anonymous. Account-based money has to be real name. Not only real name, has to be based on know your client, due diligence. So account-based money has a lot of safeguards. Token is very different. Token, you don't have to have any account. You don't need to open an account anywhere. You can own cash, right? So token can be anonymous. I can buy a Coke in a store. That store will never ask me who I am, right? It's anonymous. So it allows anonymous transaction. It does not rely on any account. You don't need to open an account to own cash, right? Cash is token. So token and account-based money are very different. Now some people are talking about tokenized bank deposit. So my first question is this account-based money or token-based money, right? If it's account-based money, it cannot be a token. Or even if it's a token, it's not the kind of token we talk about because it's a real name. The bank knows you. The bank knows your background. The bank has to do due diligence. So account-based money cannot be used as convenient as anonymously as token, right? So that kind of token to me is not real token. It's still account-based money, and it's subject to all the regulation of accounts, right? There is deposit insurance, but there is also regulatory requirement to qualify for deposit insurance. There is maybe a central bank reserve requirement on accounts, right? So there are all kinds of arrangements relating to accounts, and the transfer cannot be as free and easily as token. So my question is, what's the point of tokenized bank deposit if it's still account-based money? That's my question.
One more short question, and because it is late.
Okay, very, very short question. Thank you so much. Regarding point 3, which I think is very, very interesting, some stablecoin issuers argue that instead of putting the reserves in banks, they can put it in government in treasuries, basically. So I'm wondering, how would that fit under option 3? Would that also make them a shadow central bank, not a shadow central bank? How would that fit in under argument?
You are talking about option 1.
Option
Yeah, because treasury belongs to the highly liquid money market instruments. So you are talking about option one. And in ordinary times, it's okay, as I described, right? Before the financial crisis, people regard money market mutual fund as very stable because money market mutual fund, they invest a lot in treasuries, as you described. They are backed by security, by treasury, right? So before the financial crisis, people think it's very stable. They keep on net asset value at $1 per share exactly. It's like a stable share. That's pre-stable coin. But as I said, during the financial crisis, people realized that in crisis time, it's no longer stable. The money market mutual fund got into trouble during financial crisis. The Fed had to step in. Otherwise, the money market fund could fail. If they fail, this share or this token is no longer NQA, right? If there is a danger of failure, then it's no longer NQA. So that's the argument, because I think we learned from the global financial crisis that treasury bills and other money market instruments, they're not perfectly safe. And if not, they're not perfectly safe. If they can fail during financial crisis, it may not be NQA. That's the argument. Yeah.
Okay. This has been terrific, Bo. Thank you. I'm sure we could continue to discuss these issues for a while, but I know you haven't even had a chance to have lunch. So why don't we end it there? Thank you, everyone.
Thank you. Thanks. Thank you.